Welcome back to the Deep Dives. Okay, today we are digging into LegalZoom's Q2 2025 earnings call. This one really made waves.
Oh, absolutely. The call was August 7th, after hours, and the market reaction the next day was just, well, dramatic.
Dramatic is putting it mildly. The stock popped, what, over 31%?
31.2%, yeah. You just don't see that kind of move every day on earnings. It signals something fundamental changed, or at least the perception of it did.
Right. It tells you management didn't just, check the boxes. They must have convinced the market that this strategic realignment everyone's been watching, it's actually happening, and maybe faster than expected.
Exactly. That's the core of it. They seem to be ahead of schedule on the big pivot.
So our mission today, let's really unpack that execution. How do they drive that margin expansion? Is this shift to subscriptions really accelerating? And, what's the real story here for the long run? Let's get into it.
Okay, starting with the top line, the numbers themselves, the headline was definitely positive. Total revenue hit $192.5 million.
Which is up 9% year over year. Solid growth.
Solid growth, and importantly, it beat the street pretty comfortably. Consensus estimates were hovering around, I think, $182.7 million. So yeah, a significant beat there.
Nice beat on revenue. But for me, the real story, the thing that probably got investors excited was the leverage, the efficiency.
Agreed. While the non-GAAP EPS, $0.15, that was pretty much in line with expectations. But the operational profit, that's where it got interesting.
Tell us about the adjusted EBITDA.
Right. Adjusted EBITDA came in at $39.0 million. That translates to a 20% margin.
20%. And how does that compare?
That's the kicker. It's a 400 basis point improvement compared to last year. 4 full percentage points.
Wow. So significantly more revenue, but they manage costs way better. That's operational leverage in action.
Exactly. It shows they can scale profitably. The GAAP net loss was tiny, only about $0.3 million, basically zero EPS, almost noise compared to that operational strength.
Okay, so that sets the stage. Revenue beat, strong margin expansion. Now let's get to the heart of the matter. This strategic pivot they've been talking about for ages.
Yeah, the big shift. Moving away from relying solely on, the ups and downs of new business formations and building a more stable, predictable subscription business.
Has it been just talk, or did they actually deliver this quarter?
They delivered. And here's the punchline. Faster than they even expected internally. Subscription revenue grew 10% year over year.
10%, so hitting double digits.
Hitting double digits, reaching $119.9 million. And management specifically called out that they achieved this milestone 2 quarters ahead of their own internal plan.
2 quarters early. That's significant acceleration.
Yeah.
And what about the number of subscribers?
Also strong. Total subscription units were up 22%. That's really becoming the engine, the core of the business model now.
That makes sense. That acceleration had to be a huge driver behind that 31% stock move.
But, okay, let's pause on something here. Bit of nuance.
Oh.
Even with subscriptions firing, transaction revenue still grew, right? Up 6% to $72.6 million.
Correct. Still growing. But ARPO, average revenue per offering, that was actually down 6% year over year. How does that square? Management had an explanation, didn't they?
They did. They framed it as a strategic mix shift. Basically, they're bundling more of the lower-priced stuff, think forms, e-signatures, maybe some basic bookkeeping, into the initial higher-value formation packages.
So the idea is get the customer in the door with a comprehensive package, even if the average initial price point looks a bit lower.
Kind of like a classic sauce, land, and expand play, yeah. You sacrifice a little bit of that upfront ARPO.
But you hook them into the ecosystem with multiple services from day one.
Precisely. The goal is a stickier customer, someone with a higher potential lifetime value, or LTV, because they're embedded in more products. It's a trade-off, banking on long-term value over immediate transaction size.
It's a volume to value play, basically.
Yeah.
Makes sense, but you got to execute on that retention.
Absolutely. And this focus on, let's call it strategic discipline, it shows up beyond just revenue. Look at the cash flow.
Right. We mentioned the 20% EBITDA margin. What about cash?
Free cash flow, FCF. It jumped 82% year over year. 82%.
Well, okay. To what level?
$31.6 million in the quarter. So they're not just profitable on paper, they're generating significant actual cash. And they've got a strong balance sheet to back it up, about $217 million in cash and equivalents.
That kind of FCF generation always makes you wonder about capital returns. Do they talk about buybacks?
They did. They're actively returning capital, bought back 2.2 million shares in Q2.
For how much?
Cost them about $20.4 million. And they still have roughly $130 million left on their current buyback authorization.
That sends a strong signal, doesn't it? When a company with their growth profile starts generating that much cash and buying back stock aggressively.
It absolutely does. It suggests management thinks the shares are undervalued, and they're confident that internal cash flow can cover both investment needs and shareholder returns. It's a sign of confidence.
Okay, let's pivot slightly. It's not just how they charge, but what they're selling. This whole shift from DIY, do-it-yourself, to DIFM, do-it-for-me.
Right. Moving up the value chain. Less about just selling forms, more about providing complete solutions. Think higher touch, higher margin services.
What's the flagship product there?
It seems to be their Compliance Concierge suite. This is pitched as their premium sort of white glove service for small businesses that need more help staying compliant.
So combining tech with human oversight.
Exactly. Using AI for some of the heavy lifting, the speed, the initial checks, but then having human experts ensure everything is actually correct and filed properly. High touch, high value.
And is it working? Are customers biting?
Early signs seem positive. Management specifically mentioned that these compliance products are showing, quote, encouraging improvement in first-year retention.
Which ties right back into that LTV focus we talked about. Get them in, keep them happy, keep them paying.
Precisely. And this DIFM push is also getting a boost from M&A, right? The Formation Nation deal.
Ah, yes, Formation Nation. How much did that contribute this quarter?
Over $12 million in total revenue. The bulk of that, about $8 million, was actually transaction revenue.
Interesting. Was the integration just about adding revenue, or did it fit strategically?
It seems quite strategic, actually. Management highlighted that the integration was moving fast, and they specifically repositioned about 17%, nearly a fifth of the Formation Nation sales team.
Reposition them to do what?
To focus on selling LegalZoom's own higher-end stuff, the subscription products, the DIFM services we were just discussing.
Ah, smart segmentation. So use the acquired brand, which I think is Inc., Authority.
Inc. Authority.
Using Authority is maybe the lower cost volume play to acquire customers, and then leverage the main LegalZoom brand for the premium upsell and the subscription relationship.
That looks exactly like the playbook. Acquire efficiently at the low end, then convert to the higher LTV offerings under the premium brand.
Makes a lot of sense. But it wasn't all smooth sailing, was it? Didn't transaction units decline?
They did acknowledge that, yeah. Transaction units were down 5%.
And the reason?
They attributed it to a couple of things. One, focusing on what they called quality share, basically, not chasing every single low-value transaction. And two, a bit of a drag from lower filings related to that new BYR rule, the beneficial ownership reporting.
So again, that discipline narrative. Choosing quality over quantity, even if it means a slight dip in unit volume in the short term.
That's the argument. They're consciously letting go of some lower quality, maybe high churn, one-off deals to double down on customers who are more likely to stick around in that subscription model, trading today's transactional dollar for tomorrow's recurring LTV dollar.
Okay, but the obvious question is, can they maintain that discipline if the overall environment for starting new businesses gets really tough, if that macro headwind picks up?
Management seems to think so. Their confidence really comes through in the guidance they issued. They actually raised their full year 2025 revenue growth target.
Raised it from what to what?
They bumped it up to approximately 8% growth for the full year. That's up from their previous forecast of around 5%.
Raising revenue guidance while transaction units dipped slightly. That shows real confidence in the subscription momentum, decoupling them from just formation trends.
Exactly. And crucially, while raising revenue, they reiterated their full-year adjusted EBITDA margin target of 23%.
23%.
How's that?
That's ambitious. So they believe the 20% margin they hit this quarter wasn't a one-off, it's sustainable, and even has room to grow.
That's the signal they're sending. And the Q3 revenue guide was pretty specific, $182 to $184 million. It all points to confidence in the model shift.
Okay, so the business model is shifting, margins are up, guidance is raised. Let's talk about the future. What's the next big catalyst or moat they're building? Sounds like AI is a big part of the narrative.
A huge part. They're positioning AI not just as, an efficiency tool, but as a core strategic differentiator, something that could massively expand their total addressable market, their TAM.
How specifically? They mentioned partnerships, right? OpenAI, Perplexity.
Yeah, let's dig into that. The OpenAI collaboration, for instance. The idea is to allow ChatGPT agents to tap into LegalZoom's legal knowledge base for analysis, maybe even document generation.
Okay, but how does that help LegalZoom make money? Does asking ChatGPT a legal question turn into a LegalZoom customer?
That's the last mile concept they talked about. Think about it. Today, You might ask an AI, what kind of contract do I need? And it gives you a decent answer, maybe even a template.
Right.
But you still need to actually execute it. You need to tailor it, sign it correctly, file it if necessary, make sure it complies with your specific state laws. That's the last mile.
So the AI does the initial discovery, the general advice part, which used to require maybe an expensive lawyer consultation.
Exactly. And then LegalZoom steps in to provide the actual service, the execution, the compliance guarantee, using a combination of its own AI tools and human expertise.
So they're essentially positioning themselves as the execution layer for insights generated by these massive AI models.
Precisely. It's a potential fire hose of new customers. People using ChatGPT or Perplexity Pro might discover they have a legal need they didn't even recognize before, and boom, LegalZoom is right there, integrated, ready to solve it.
That's a potentially huge TAM expansion, moving beyond just people actively looking to form a business.
Absolutely. And it feeds directly back into making their core products stickier. They mentioned using AI automation for compliance tasks too.
Like what?
Like automatically generating and filing annual reports for subscribers, making compliance effortless.
Okay, interesting. Even if there's a filing fee associated with that, which might hit transaction revenue.
Right. Even if it shows up there technically, the strategic goal is reducing friction and churn in the high-value subscription product. It's about making that core service indispensable so customers never want to leave. An investment in retention.
Really interesting how all the pieces, subscriptions, DIFM, AI, M&A, seem to be fitting together into a coherent strategy.
Okay, fantastic breakdown. Let's shift gears.
All right, time for our favorite segment. The segment where we channel our inner hedge fund analyst. Remember, everyone, this is not financial advice. Seriously, this is just us kicking around a plausible, maybe slightly outrageous trade idea based only on what was said in the earnings call.
Purely a thought experiment. Okay, so our pitch today centers on capital allocation, specifically accelerating it.
The core thesis is this. The market might be underestimating just how ready and able management is to return cash aggressively right now.
Why? Well, look at the evidence from the call. They raised full-year revenue guidance to 8%. Free cash flow jumped 82% year over year. They're sitting on $217 million in cash. The financial engine is humming.
And then there's the potential catalyst we picked up on. Did you catch the mention of the tax law change?
Yeah, that was subtle but potentially important. Management explicitly called out a positive cash flow impact coming from a provision in that One Big Beautiful Bill Act.
Specifically allowing accelerated tax deductions for R&D spending.
Which translates directly into more cash sooner, a near-term tailwind.
Okay, so putting it all together.
Yeah. The pitch is, use the momentum. Launch an immediate, aggressive, accelerated share repurchase program in ASR. Take that remaining $130 million authorization and put it to work now.
Funded by what?
Funded by that strong underlying FCF generation, plus the extra boost from that R&D tax deduction tailwind, plus the existing cash pile. The firepower is clearly there.
And the impact of an ASR.
It pulls forward the share reduction. It acts like a turbocharger on earnings per share, magnifying the impact of all the operational improvements we just discussed. It's a way to add a secondary catalyst on top of the already strong fundamental story.
High conviction based on the reported financials and the specific mention of that cash flow tailwind. Aggressive, plausible, but definitely high risk.
And one last time, purely theoretical, not advice for you, the listener, to actually go out and do.
Okay, let's wrap up this deep dive. What's the key takeaway from LegalZoom's Q2?
I mean, they crushed it, right? It was a strong execution story across the board. That double-digit subscription growth, hitting it 2 quarters early, that was big.
And the operational discipline really stood out. Those margins expanding significantly, the strong cash flow. They proved they can grow and become more profitable.
Definitely. And the roadmap seems clear. Focus on those higher-value DIFM services, leverage Formation Nation smartly, and weave AI through everything for both customer acquisition and retention.
Yeah, this quarter really solidified the narrative shift. They're building a business that feels much more resilient, less tied to the whims of the business formation cycle, and anchored in that recurring revenue and operational efficiency.
You can see why the market reacted the way it did. The story is compelling now.
Absolutely. So as you're thinking about all this, here's a final thought to chew on. Management explicitly said they're aiming to compete with the old line lawyers and law firms market. That's a huge target.
Massive market.
So if these AI partnerships with OpenAI, Perplexity, etc., truly start funneling in users who didn't even realize they had a legal need before, How quickly could that new, potentially high-value customer stream start impacting their core metrics? Think subscription retention, think ARPU. Could we see another acceleration driven by this entirely new channel?
That is the multi-billion-dollar question, isn't it? Definitely the long game to keep a close eye on.
Indeed. All right, that wraps up our deep dive for today.
Thanks for tuning in. We'll catch you on the next one.